hopefully it won't. So as far as the only thing I'm going to talk about as it relates to cash is you need money to pay bills. You're not going to be sustainable or viable in business if you can't pay your bills. So cash is king. Profits are also important too. So both aspects are crucial in keeping a business going. When we talk about what the term financial reporting, what we're dealing with are a group of financial statements that are all included together. The financial statements that are most common in businesses include the balance sheet, the income statement, the statement of owner's equity, and one that we have not spent much time talking about, and I'm not going to in this class because I think you have enough with what we're dealing with, would be the statement of cash flows. So while the income statement shows us the profit or earnings made with the company, the statement of cash flows allows us to see how cash is spent and brought in. Cash isn't just brought in because of profits earned. Cash is brought in because of loans that are borrowed. Cash, it goes out to pay back loans. Cash goes out to pay bills. So cash involves more than just earning profits. It involves how they have uses and sources of cash flows. That's all I'm going to talk about with cash flows. So the most important thing that you need to know is, they're needing my accounts. Certain concepts of relevance, like we talked about earlier, that the information we're providing will allow a user to, will assist a user in making decisions. So if the information were not available, then potentially a different decision may be made. So relevance means it's going to be applicable to the user. When we deal with what we call faithful representation, that means we can trust the information. It's not filled with errors. It's complete. It includes or encompasses all of the various transactions throughout the period of time. Complete, neutral meaning it's not rigged. It's truly what the company did. So those are the two, the most important pieces as it relates to faithful representation. That other quality is relevance. Important aspects as it relates to being able to understand and use financial information, it should be able to be comparable, which means two companies of the same sector should be able, you should be able to put two businesses against each other and be able to draw some similarities and conclusions. So you can compare between years, one year to the next, or you can compare from one company to another company. It should be able to be verifiable. The information you're seeing, you should be able to find out if it in fact is truly true and correct. And it should be presented to you within a reasonable amount of time that it's recent enough to where you can use that information to make a decision. An example, if I look at Delta's financial statements from 4 years ago, am I going to use that information to make a decision about buying their stock today? No. I kind of need the current information in order to make a useful decision. So that's really important. Am I going to know how Delta's doing if I just look at 2014's financial statements? I just don't know even how to relate it to. If I have several years, it helps me understand how they've, I can compare from one year to the next. Or if I can compare Delta to American to United, it's going to give me more understanding it's going to mean more to me than just a set of financial statements. And we need to be able to understand what these financial statements are even telling us. Where do we look for profits? Where do we look for total assets? What do these things mean? And so we need to make it in an elementary term enough to where the average user can understand these financial statements. All of this is good, but it still needs to be affordable. So we've got to be able to produce them quickly enough, compare them enough, and have them have faithful representation in a fairly economical manner. So we've got to make them fairly affordable, yet honest, in order for people to utilize them appropriately. So consistency means that one company has adopted a certain accounting procedure, such as depreciation. They need to continue to use that same procedure from period to period unless they let users know, based on disclosures in the financial statements, that that procedure has changed. So when we're dealing with depreciation, once you begin a method, you have to continue with that method. Once you begin a manner in allocating resources, you must continue that same application unless you inform users of the need to change. Full disclosure means all information that help the users need to be there. So explanations, any significant events that have happened, all need to be there. So for example, let's just say British Petroleum closed their financial statements, and a month after, as the auditors were preparing the financial statements, the oil spill happened. Even though that didn't happen in that current period, British Petroleum needs to inform users that that occurred. Even though it wasn't in that period, that information is going to wreak significance on if a person wants to invest in their stock or whatever the purpose is. So all information needs to be disclosed, even if it's not in that period, to help users make best use of that information. Information needs to be conservative. What does that mean? If the company has a choice between opting for one manner of reporting versus another, the accountant should always choose the most conservative approach, which means to always understate assets likely to, they need the one that is least likely. So they need to understate assets, they need to understate income. So what they're saying here is the accountant should choose the one that is least likely to overstate assets and overstate income. They need to be more conservative and make sure if they err in keeping things lower. Because why? Because generally companies want to inflate figures, not deflate them. Sarbanes-Oxley is an act that was passed in 2002 that made some sweeping changes to financial reporting. And one thing that they now require is that the CEO and CFO of public companies personally have to certify that the financial statements are complete. So basically, they are now held personally liable for the accuracy of the financial statements. In the past, they were able to say, oh, but I don't know accounting. No, you don't get to do that anymore. If you're a CEO of a company, you better know accounting or get out of the job. So they can be held personally liable for inaccuracies if they are shown to be true. Fraudulent financial reporting can ultimately cause a lot of debt for a lot of people and a lot of innocent people. And so the reason that they are making CEOs and CFOs certify them is to help eliminate innocent people being the victims of their greed. So I really did this fast, but the items that I pinpoint it, I want you to know. If I talked about something like predictive value or things that we didn't talk about, don't worry about them. So now what we're going to do is talk about a balance sheet. We've created some balance sheets in the past, and we basically, with our balance sheets up to date, we show all of our assets together, and then all of our liabilities, and all of our owner's equity. The classified balance sheet gives more classifications to various types of accounts. So as you'll see here, it's a little more detailed. It's got the same accounts, but we break them into several components. So when we're dealing with external financial statements, we are going to have some categories such as what we call subcategories in the various classifications. Assets. As you see here, assets have a variety of assets. We've got current assets. Current assets are basically those accounts or assets that can be converted to cash within the current operating cycle. Cash is always already cash. Accounts receivable will become cash within the current cycle. So will inventory and prepaid items. So we're going to link our current assets together in the big asset umbrella, but we're going to show where our current assets are linked separately. We're also then going to show a separate category for investments. Now we know investments are usually longer than a year. Current assets are going to be converted to cash in less than a year. So we'll show our investments, which generally are going to take a little longer to be converted into cash. Then we have something called property, plant, and equipment. Those are tangible assets that we use within our business. That may be equipment, machinery, office buildings, factories we utilize. Those will all be put under property, plant, and equipment. And then last we have something called intangible assets. They have value. There's worth in them, but you can't see them. They're trademarks, goodwill, franchises. So we separate out our hard equipment, tangible assets, from our intangible assets. On the liability side, we're going to separate our liabilities into two categories. One we call current liabilities, those that need to be paid within the current operating cycle. And then long-term liabilities are those debts outstanding that will be paid off in longer than a year. And then owner's equity will show the capital part. So we'll talk about why this is important. It's going to allow us to gain better understanding of these various accounts. You're yawning and I'm yawning now. So as you look at this balance sheet, this is a classified balance sheet of just the asset section. As you see here, it always begins with the most liquid assets. So we start with the current assets and we list them in order of liquidity. We'll always start with our cash, then our short-term investments, our notes receivable, that will be converted into cash within the current operating cycle, our accounts receivable, any inventory, prepaids, and supplies. Generally speaking, those are the biggest accounts that make up our current assets. Next, we have investments. Investments are items that have a future benefit, but we don't utilize them in the business. So let's say we purchase land that we maybe plan on eventually building on, but we own the land today. That would be an investment because we're not currently using it. The property, plant, and equipment are those tangible assets we are utilizing in the operations of the company. So as you see here, land, buildings, equipment, all that are utilized to provide a service or make our product. Then last we have the intangible asset. In this balance sheet we only have a trademark. So those intangible assets will be treated in a subcategory on their own. All of them make up assets, but you see how we break them into specific categories. Then the second part of our balance sheet would be the liabilities section and the owner's equity section. The liabilities section we're going to break into current and long-term liabilities. Again, current liabilities are those liabilities that we need to pay with money within the current operating cycle. So our notes payable of 60, our accounts payable of 102, our salaries payable, all of that money, we're going to need that cash to pay those off in the next 12 months. Our long-term liabilities, these are liabilities that are not going to be due within the current operating cycle. It's going to be long-term. So the reason we want to separate out the current from the long-term is we need to know how much cash we need on hand for this period. And then our owner's equity is going to be similar to what we've done before. We're going to show the capital piece, and we know our total liabilities plus our owner's equity gives us our total liabilities and owner's equity, which is always going to equal our total assets. So assets, 4 categories: current assets, investments, the property, plant, and equipment, and the intangibles. We always list them in the order in which they're most liquid, or the soonest they can be converted into cash. That's why cash is the very first. Can't get more liquid than cash. Some companies group investments, intangible assets, and other miscellaneous assets into categories that we just call other assets. Current assets include cash and assets a company can expect to convert to cash or sell or consume within a year. So our supplies we're going to consume within the year. Our inventory we're going to sell within the year. Our accounts receivable and notes receivable, we want to convert those into cash within the current year. Current assets include cash, short-term investments, notes and accounts receivable, inventory that a company expects to convert into cash, prepaid expenses, and supplies. Investments are going to be those things that are long-term. They're not going to be used within the normal business operations. And management doesn't plan to convert them into cash within the year. So if companies have investments in securities that they plan to hold long-term, they're going to be listed in investments. If there may be long-term notes receivable, we're not going to get the money within the current year. We would put those in investments or land held for future use. If we have any types of buildings or equipment that we own but we don't use for the company, they will be put into investments also. Another investment piece, I don't think we're going to get into this much in this book, but there are sometimes monies we accumulate for a specific purpose, but we're not going to use that money in this current operating cycle. So if we create certain types of funds or monies that we're saving to do something unique with, but we're not planning on doing it within the current year, we'll put them in this investment category. Property, plant, and equipment are long-term assets that are used in day-to-day activities. Fixed assets, long-lived assets. We know and we've learned about depreciation. We take into account that accumulated depreciation when we're dealing with our tangible assets. Land is one asset we will never, ever depreciate. Just know land never, ever is depreciated. So with our balance sheet, we will take into account our accumulated depreciation on our various tangible assets. So when we show net assets, such as what I did right here, it shows property, plant, and equipment net of $116,240. What that means is the cost, or what we purchased it for, is higher. But when we subtract all the depreciation we've taken on those assets throughout the life, the net of it, what we bought it for minus the depreciation, nets us the $116,240. That's how we'll show it on the books. Then we know intangibles can be patents, where we have the right to sell a certain product exclusively for a period of time. Copyrights, franchises, trademarks, and goodwill are the intangibles. They have value, but we can't physically see them. Liabilities, two categories. Current liabilities have their obligations are due within the current year. Notes, accounts payable, and if we have long-term debt, the current part of that long-term debt is going to be put into the current liabilities section. We know salaries and wages payable needs to be a current liability, because do you think an employee is going to wait a year to get paid? I don't think so. Customer advances, remember that unearned revenue? That's also going to be a current liability. Long-term liabilities are generally going to be long-term debt. Mortgages, long-term notes, or bonds. Employee obligations are also long-term debt, because usually we need to have those monies for that employee way far out. Equity is the difference. Equity is the net worth. They're different terms: owner's equity, proprietorship, capital. All of that refers to the extra, the residual that the owner has in the company. The equity section is going to differ based on what kind of business we're dealing with. So if we're dealing with a sole proprietor, we're going to deal with owner's equity or proprietorship equity or capital. If the company is a partnership, then we're going to be dealing with partners' capital. If it's a corporation, we're going to be dealing with stockholders' equity section. So the equity section is going to vary based on what kind of business it is. So when we're dealing with a sole proprietor, you see the owner's equity section gives us his name and says capital. That's common for the equity section. With partners, it's going to show the list of various partners and the capital amount. The difference here is there's going to be more than one. Then when we're dealing with the corporation, we're going to have a couple, it's a little more complicated. We are going to have the contributed capital section, which is basically the stock part. The stock, which is like owner's equity, what people have purchased to own a part of the company. And that stock basically gets treated as just the par value is shown separately. And then the additional paid in capital is the amount that stockholders have paid above the par value of the stock. So for example, let's just say that we want to purchase stock of 3M, let's just say. And 3M stock is currently trading at $70 a share. But the par value is $10 a share. And we purchase 1 share of 3M. In the common stock $10 par, we're going to show $10. Because even though it's selling for $70 a share, the par value of 1 share is $10. The portion that says additional paid in capital is going to be the extra $60. Anything above and beyond, we pay for that stock above and beyond the par value, is going to go into additional capital. So the common stock at par and the additional capital are going to total to be your total contributed capital. The retained earnings section is the accumulation of all the years of income from a company, less the retained earnings from a company. So the retained earnings section is all the income that's been added to a company, less any dividends that have been paid out over the time. Am I going too fast for you guys? Is it making sense? So contributed capital reflects the amount of assets invested by the stockholders. Two amounts, the face or par value, and then the amounts paid in or contributed in excess of that par value. The retained earnings is sometimes referred to as earned capital because it's basically the net income from the company, which ultimately the shareholders get. Any type of distributions to the shareholders would be treated as dividends. Now, in a sole proprietorship, we call them withdrawals, don't we? In a corporation, we would call them dividends. So, as you see here, we are showing our various groupings of assets, liabilities, and owner's equity. And we still have that same equation. Our total assets are always still going to equal our total liabilities plus our owner's equity. So I think we're going to take a minute and let's go over some problems here, okay? So if we go to page what page do we start our
194.
Thank you. Whoops, wrong book. Okay, let's look at E3. Let's do E4A. The following data pertain to Wagoner Company, and it gives us a list of various accounts. It tells us about accounts payable, accounts receivable, accumulated depreciation, building, accumulated depreciation of equipment, bonds payable, buildings, cash, copyrights, equipment, inventory, investment in corporate securities, investment in 6-month government securities, Y Wagoner Capital, land, prepaid rent, revenue received in advance. What we're going to do is create a classified balance sheet. So as we were looking, remember how our asset section has 4 different areas: current assets, investments, property, plant, and equipment, and intangibles. Let's just kind of talk about this. Which of these do you think would fit into current assets?
Accounts receivable.
I'm sorry, what? Accounts receivable? Perfect, yes.
Cash.
Cash, absolutely, the very first one.
Inventory.
Yeah, inventory. Probably investment in 6-month government securities because it's under a year, right?
Land.
Prepaid rent. I'm sorry, what?
Land.
Land is property, plant, and equipment. So let's go here, guys. Let's pull this sucker up. So, if we go, oh, I do have something I can hand over to you guys. I do have just the problems in a sheet there. Okay, let me see. I do. I'll email you this, okay, guys? I'm so sorry. I have it. Okay, I'll put it up there. Actually, you want me to do that right now? Or just do it later?
You can do it now.
And remember, your only homework assignment is problem 1, okay? Even though you might see more of them there. Okay, there you go. Okay, let me just go here to what number was this? E4A. So what you should see in the section of your balance sheet should be, as you see here, you start with the balance sheet, and then you're going to start with your current assets. Cash will always be first. Short-term investments, the accounts receivable, inventory, and your prepaid rent. Does that make sense, guys? Okay. I'm going to pull it up so you can see it a little better. Here it is. Then, as you can see here, if you look back at the book, the next section relates to your investments. The only investment we have there is investment in corporate securities. Next is going to be your property, plant, and equipment. And in that property, plant, and equipment, you'll have land. Land will never have any depreciation, so you'll never have an accumulated depreciation to offset that. Land's on its own. Then you see building. Now, do you see how we show in the first column the full purchase price? Right under it, we then show less accumulated depreciation of $5,600. And then we move over to the second column, the difference. The difference between what we purchased it for minus the accumulated depreciation that we've taken, or $22,400 to show our net building. We do the same with our equipment. We show the full amount of our equipment, then we take less the accumulated depreciation to come with the net amount of our equipment, or $54,000. We'll then total in the third column our total property, plant, and equipment, which is a combination of our land, our building net, our equipment net. And we'll have our total property, plant, and equipment here of $79,600. Then the very last piece we'll have in assets would be our intangible assets, and the only intangible we show would be the copyright. So all these various columns can be confusing for people. The purpose of it is to help you organize the balance sheet so it is easier to read. So as you see in the third column, all we show are the totals to our subcategories. And we use those other columns to help us create our totals to the subcategories. How you guys doing? Next, if we look at our liabilities, we're going to split them into current and long-term. Current liabilities are those debts we owe in the current operating cycle. It gave us a list earlier of the various types of current liabilities. Accounts payable and notes payable would be current liabilities. Unearned revenues, or what we call revenues received in advance, are current liabilities. And so we're going to show the combination of the two accounts, and then we carry over into the next column a total of our current liabilities. We do the same thing with our long-term liabilities. So instead of just having one long-term liability, say we had two, we would total them in that first column there, and then we would list them each in the first column, and then we would total them in the second. In this case, since all we have with long-term liabilities are bonds payable, we just put it into that second column. So then we total our liabilities. Next, our owner's equity. We show Y. Wagner, and that's our total owner's equity, is just our Y. Wagner. Then we total our liabilities and our owner's equity, and that figure should always match our total assets. How you guys doing? Making sense? Okay. So, as we go back here, let's start talking about a couple various ratios. Oftentimes, it's not always real helpful for a user of a financial statement just to look at a financial statement and go, yeah, okay, it makes sense. Oftentimes we compare by using various types of ratios. And there are ratios related to specific aspects of a company. Liquidity means how able is a company to pay their debts. Liquidity is important. You need enough liquidity to pay your debts. Sometimes if there's too much liquidity, then they're not utilizing their assets like they should be. But liquidity ratios we're going to look at relate to what we call the working capital and the current ratio. Then we can look at how profitable a company is by looking at various types of ratios here. As you see, the profit margin, the asset turnover, return on assets, debt to equity ratio, and return on equity. So those ratios relate to profitability. So how do we use this? Why do we use it? We basically use these ratios by taking figures in financial statements and make sense of those figures in the form of a ratio. So before we can even create a ratio, we've got to have the numbers correct, and we've got to be able to show our various accounts with our correct balances. So the first step is to create financial statements. Then after that, we can take those balances and create ratios. Liquidity means you have enough money to pay the bill. Basically, the two ratios we use, or evaluations of liquidity we use, relate to working capital and the current ratio. Working capital is basically the amount in which our current assets exceed our current liabilities. So we would just take our total current assets, subtract them by our total current liabilities, and the difference is what we call working capital. That capital we have available to use. Okay? That's the first one. So I'm going to want you to learn how to compute working capital. The next is called the current ratio. This is taking the total current assets and dividing them by current liabilities. So if we take our current assets of $467,424 and we divide them by our total liabilities of $170,732, we come out with a ratio of 2.74 times. What that means basically is we have 2.74 times the amount of assets that we do the liabilities. Okay? So that is a fairly strong ratio to know we can pay our debts as they come due. So you create a current ratio by taking total assets and we divide them by total current liabilities. To determine whether a current ratio is good or bad, we got to compare it to other ratios. We might compare it to ratios within the same company for previous years, or we might compare it to similar companies. So as you see here, Bonali's current ratio of 2.74 is greater than the average of the industry. So this is a clothing industry. So as you see here, in the clothing industry, if we look at the industry average of clothing stores, the sector of the economy, the average current ratio is 1.8. So Bonali's is 2.74, which is better or greater than the industry average. Okay? See how you need to have a benchmark to compare ratios with? Then we can look at something called profitability. Are we making enough income? Or how is our income in comparison to other years or other companies? Profitability competes with liquidity because liquid assets are not the best profit-producing resources. There's always a pull for money. So how much do we keep in current assets to pay our bills? And how much do we invest in the company to make more products? There's always that pull. So how we determine the ability to make money is going to be on a profit margin, or something we call asset turnover, return on assets, or the debt to equity ratio, or return on equity. So the profit margin basically shows the percent of each sales dollar that ultimately results in net income, that bottom figure. So basically, if we look here, Bonali has $71,524 of net income, and it has $1,248,624 of revenues. So its profit margin is going to be 5.7%. How do we figure it? We take the $71,524, which is net income, we divide it by its revenues, and we come up with 5.7%. If we look at the clothing store industry average of a profit margin, we see it's 4.2%. Are we better or are we worse? We're better than the industry average. Our profit margin is a whole percent better than the industry average. Next, we have something called the asset turnover ratio. The assets we have, how efficiently are we using these assets to make sales? High asset turnover uses its assets more efficiently. They're utilizing them. When you have what we call a low asset turnover, you have a lot more assets and you're having a harder time making money with these assets. So the way we calculate asset turnover is we take all the revenues divided by the average total assets, and then we divide it by 2, because we take the beginning period and the ending period of the assets and divide it by 2 to come up with an average. So Bonali's asset turnover is 2.03. So as you look here, if we take the revenues, which are the $1,248,624, we divide it by the total assets at the beginning of the period plus the beginning assets the ending total assets at the end of the period, divided by 2, we come up with an average. So as you see here, if we take the revenues, divide them by the assets, we come up with an asset turnover of 2.03 times, which means the assets are being utilized to make money 2.03 times per year. If you look at the industry average, it's 1.05. That basically means this company's being more efficient in utilizing their assets than the industry average. Now we have something called the return on assets ratio, and basically this is going to take our net income to our total average assets. If Bonali's net income was $71,524, we take that and divide it by its total average assets, which is going to be 11.6%. So basically, you see that the return on total assets of 11.6% really helps us to see our net income divided by what our total assets are. So we're basically bringing in income of 11.6% on our income, on our total assets. So you see here, another way you can calculate return on assets is you can take the profit margin times the asset turnover, and it's going to basically give you your return on assets. Or we can calculate it just like we did. Our net income, divide that by our total average assets. You see how on this one we can come up with it in 2 different fashions. So if we look at the comparison of Bonali as it relates to the clothing store, they're doing pretty well. Their return on assets is 11.6%, where the industry average is only 6.3%. Then we show, again, another profitability ratio, what we call the debt to equity ratio. The proportion of a company's assets that are financed by creditors and what proportion is financed by the owner. So basically, the more debt a company has, the more profit it must earn to ensure payment of interest to creditors and a return of the owner's investment. So if we look at Bonali, 61.4% means it has 61.4% debt to equity. So as you see, the 61.4% debt to equity, the clothing store has 112% debt to equity. So again, their debt to equity ratio is going to be lower than the industry. Then we have something called return on equity. Basically what we're doing there, we take the net income divided by the beginner's owner's equity, we add to it the ending owner's equity divided by 2 to come up with an average. So as we see here, if we look at it, we see that Bonali's return on equity is 18%. Again, they're rocking. The industry average is 14.4%. So the net income they make based on their equity in their company is at 18.4%, but the industry average is only 14.4%, so they are exceeding the industry average here. So let's do a couple problems here and go through some